And there are now, how do we pull all these gaps together and the piles of paper and transactions and get to financial statements? And the good news is that there are four. What are those four? The first is the income statement. What is the objective? We want to learn, did you earn a profit? Did you grow sales? And some of the information you'd find in that statement would be revenues, cost of goods sold, operating expenses like salaries and rent, income taxes paid to the government, and what is the bottom line or net income. All right, so that's the first one. Income statement makes sense, revenues and profit. Second one is the balance sheet. The objective is the company healthy? What are the assets, liabilities, and equity for the company? That's called a balance sheet. Examples of information and line items would be things like the book value of assets, like cash, receivables, inventory, property, or the amounts that we owe to somebody else, like loans to the bank, or the amount of capital that shareholders have invested in the business to provide money for the business to launch and to grow. And how much profit did you make from your income statement that you kept in the business? You make profit, you could turn around and just give that money to the owners because they are the owners of the business. Or you could keep some or all of that profit so they could use it to grow the business. And you'll see that what we just described is what we call retained earnings. They're earnings that we retain in the business so that we can use that money to grow the business further. Next is a statement of cash flow. And here, did we generate cash or did we use cash? And more specifically, we break it into three types of activities. The first block is from running the business. We call that operating activity. The second was, how much have we invested in the future? It could be buying hard assets like equipment, property, plant, equipment, or it could be buying another company, an acquisition of another company. So those are shared objective of putting assets in place so we can continue to grow the business. Then there's the third activity, which is financing. It's financing either by getting loans from banks or issuing bonds to the marketplace or selling stock to people who then become shareholders of our business. So those financing activities is the third activity that goes into the statement of cash flow. The fourth is a statement of shareholders' equity, and that is how much money did the shareholders put in? And how much money did we earn? And how much money did we pay in dividends back to them as owners? So this section, if you think about it, is what the owners want to look at, because what happened to my money? And so that's what is in the statement of shareholders' equity. Examples of information we would find there would be sales of common stock during the period, or did we repurchase some of the previously issued shares? Did we pay dividends? And how much profit did we earn? So those are information we see. Now, as you think about it, there's some overlap between these four statements, right? Because we saw profit, obviously, in the income statement. We saw profit as probably part of the operating cash flow. And we saw profit as something that shareholders would care about in shareholders' equity. So you see that in general, there are four statements. They each have a specific purpose, but there are connections between each of those four statements. We'll get to that a little bit later, but I just wanted to point out that they're just not hanging out there, that these are highly integrated and connected statements that comprise our evaluation of how a company is doing. All right, so let's start with another idea about statements, and that is time frame and what statements cover. First is a balance sheet. Notice that the phrasing is very specific. It's as of, in this case, December 31st, year one. Okay, as of. So when I think of a balance sheet, I think of having a camera and going snap, shoot a picture. And a balance sheet is a snapshot in time as of the last day of its year. So it doesn't mean that how much cash did you have all year. It doesn't mean how much did you buy and sell in inventory all year. None of that. It simply says at the end of the year how much cash was left over. At the end of the year, how much inventory did you have left over? So that's what the balance sheet is. It's as of, and it holds for assets and liabilities, which are just money you owe to other people, and equity, which is money that is provided and accumulated for the benefit of your shareholders. Okay, there's a lot of room in this slide. So what's missing? What's missing is a year from now, you have another one of these, another balance sheet. So now you have another snapshot on one day at the end of last year, which is essentially the beginning of this year, and another snapshot, boom, at the end of this year. So now we have, in a way, like pillars, right? So we have 2 points in time. Well, the other 3 statements help connect them. The income statement is not as of. The income is for the year ended. So now we're accumulating. So as we're making sales in January, February, March, etc., we're accumulating all of those so that we can record and report how much did we have in total sales between the 2 pillars. In other words, during the year. And the same holds for expenses, leading to our ability to say what profit did we earn this year. And that is the income statement covering the activity for the year ended. In this case, December 31, year 2. Same thing holds for the cash flow. This shows you how much cash was generated or used up by the 3 activities we mentioned earlier: operating, investing, and financing. And that is also accumulated over the course of the year. So you can see how active have we been in building assets? How active have we been in selling more stock? Those types of things can be seen pretty easily from the statement of cash flow. The third is shareholders' equity. Again, accumulating what happened to my money. If I'm a shareholder, I want to know what happened to all the accounts that are relevant to my ownership interest in the company. So now we see that we have 4 statements where the balance sheet is quite different because it's as of a date, and those form the pillars between which there's the 3 other statements that cover the period. So one way to visualize it is like there's a bridge, a suspension bridge. And each of the pillars represent the year end or the balance sheet. And then the roadway that connects them are those other statements of income statement, cash flow, and statement of shareholders' equity. Now, if you have the entire roadway, you now have the history of the company from its very first inception and its balance sheet to all the activity year by year by year. All those are accumulated and carried forward as it's reflected in the balance sheet at the end of each year. So the history of a company, if you had every financial statement ever generated, would give you the entire bridge, right? The entire roadway from the beginning to the most recent financial statements that have been issued.